government-owned infrastructure projects in East Africa to the tune of 86%, despite the bulk of financing for these projects coming from China and development finance institutions. Kwame Parker is the head of power and infrastructure at Stanbic Bank and joins us now to discuss how the private sector can be engaged in these projects. Take a look. Let's start by looking at the state of capital or infrastructure projects in East Africa. We've seen it coming down generally, but what are your thoughts on the kind of trends we are seeing in terms of investment in the region?
I think the most interesting one to talk about as an example is the Standard Gauge Railway, right? Obviously the capital cost of that project has been substantial, and as we know, it's a government-to-government financing, right? So Chinese government has effectively lent money to the Kenyan government, and Kenyan government has then gone and procured contractors, Chinese, who have built the first leg from Mombasa to Nairobi, and funding is in place for the second leg that will take the project to Naivasha. The question of the value of the project and whether it was a good idea is a question that can only really be answered in time. It's almost obviously we can all speculate about whether it was a good idea or not, right? The premise makes sense. You want to move product, containers, etc., from the coast to the interior, whether it's interior Kenya or ultimately Uganda and beyond. Yes, the cost of moving the product through those through rail should be cheaper. And it should also take a lot of trucks off the road and make any road infrastructure development last for a lot longer, because you're not punishing the roads with heavy trucks. Also safety and so on in terms of accidents and so on and so forth. So there are all these kind of macro level reasons of why a project like this would make sense. But the bigger one is, did it cost too much, and can the government afford to pay for it? Yes, it probably costs too much, right? But yes, the government can afford to pay for it. And so the question becomes less about, is government doing too much infrastructure? Different schools of thought, right? You need the infrastructure to grow the economy, but how much should you do is always a question. But the more important question from my perspective is whether or not the government can pay. And Kenya is pretty good at collecting taxes, has run its fiscus pretty responsibly. And so the basic answer is yes, they can handle it. And as long as, if they're going to do 3 or 4 or 5 more projects of this scale at this point, it would make no sense, and you would start putting real stress on the economy. But from my perspective, as long as they don't do too much more and they take some time to digest investments like SGR, it's okay. And I believe in the latest budget reading, my understanding is that they've actually reduced expenditures for capital projects, which in my view makes perfect sense. We need to digest what we've done.
Beyond the financing and arranging for that, what role are financial institutions like yourself playing in terms of running of these projects?
We weren't active in the SGR discussions. Again, that was handled on a government-to-government level, but we are very involved in some of the some other big ones, such as the Kenya Roads Annuity Program. Very active in that. We have the majority of the serious clients who will actually be able to execute some of the road lots this year are Standard Bank clients. We also work very closely with government to put together the PPP framework that would make this opportunity bankable. And again, for people who don't know, this roads annuity program effectively is a 10-year concession, privately funded, very important, right? So this is not funded from, from existing sources of government revenues, where contractors and their equity investment partners construct roads over 2 years and then manage them for 8 years, and they get an annuity payment that basically covers the cost of debt and an equity return, but getting 100% of that annuity payment is contingent on keeping the road up to a minimum standard. So what's nice about it, one, it will be applied to many lots all around the country, in all counties. And you won't have the situation where you have a shoddily built road and then there's a rainy season and then the road washes away and you start from scratch. Because if that did happen, then investors would lose a lot of money. So the onus ends up being on the investors to ensure they're building quality roads on time and they're maintaining them accordingly. So that's a very exciting program that we're very involved in. In LAPSET, we are advising on the coal power plant, the Amu Power coal plant, which is obviously a large project at $1.8 billion. Hopefully it does close this year.
What's your take on the capacity of Kenyan banks in terms of being able to take up and finance these projects?
Really, when we say capacity on some level, we're actually talking less about do they have the funds to lend, then that's less of the issue. The issue is more of tenor and currency. A lot of these large infra deals are dollar denominated, and they require long tenor funding, 12, 15-year funding. And the combination of those two things, and often they're not priced very, very high. And so the combination of those things often make these transactions not particularly attractive to local banks. Local banks are very busy lending in other spaces, right? Consumer space, real estate space, etc. But they often don't play in that in those long tenor deals. Theoretically, there are things that could be done to change what these transactions look like to make them more attractive. For example, for the roads program, there are some the first set of lots are dollar lots, dollar-denominated lots, but we will do shillings for the second one. And the tenors of the debt, instead of being 12 or 15 years, is 8, right? So 8-year shilling financing for infra would be a very attractive space.
Talk to us about the impact of these projects on real estate, because I believe real estate has been a direct beneficiary of road projects and other forms of infrastructure in the country.
Well, I think it's obviously for people today who are holding land in the vicinity of these projects, I mean, whether they actually decide to develop it or not, obviously their asset values will increase substantially. For speculators who have the free cash and are smart enough to get a sense of where projects are happening and invest, again, those returns on investment would make a lot of sense, right? I think at the conference earlier, you heard some numbers, and I wish I had them, in terms of the multiples people have seen on land values as roads have come through, or better quality roads have come through. Thika Road, for example, being the easiest example. And so those benefits are very, so that kind of that first level of benefit is very clear. What we don't know, and we'll have to see how it plays out, is what is the level of economic activity that will come from things like stations along the SGR? What is the set of investments that will then show up to support that? Is it Class A office space? Is it just better quality car parks? Is it restaurants? Is it, what do you call these things? Inland container depots and so on. There's a whole set of investment, both on the kind of commercial side and on the retail side, that should show up as a result of these investments. But it's one of those things that will just play out. But again, if we use Thika Road as an example, which is a great example, because in 2010, when I first came to Kenya, Thika Road was, I believe, 1 lane each side, and it was a horribly potholed lane. And yes, there were traffic jams on that road, but who could have conceived if you put 4 lanes on each side, you would still end up with traffic jams coming into Nairobi. And obviously, the endless development we've seen up and down that corridor has been, well, it should at least give you some comfort that we would expect to see the same thing in other parts of the country. And I think what's nice about the SGR is that it does pass through areas that have not seen much investment in the past. And it'll be nice to see kind of growth there that we really just haven't even anticipated.
You've mentioned the issue of traffic jams, and typically in Kenya, a new road is getting congested after every 4 years. Does it have much to do with the state of our urban planning as a country?
I think one thing that we'd all like to see is much better quality public transport, right? With some combination of perhaps bus rapid transit systems, like Dar es Salaam has done quite effectively, quite frankly, and light rail, like Ethiopia has now done. The challenge there really is that the math is quite complicated if you think of things like light rail. The economics are challenging because if you actually put the cost of, the cost to repay these capital projects onto the consumers, right, most of who are from lower income brackets who would use it, the numbers wouldn't make sense. So you end up in a situation where the government, if they're going to pursue that, has to be very clear-eyed about the fact that they will have to heavily subsidize those types of investment. So you can argue that the lazier answer is to just build roads, bigger roads, and then let, combination of private vehicles and matatus take care of the rest, even if it isn't particularly efficient. But it's one of those things that I think in most countries, or at least in developed countries, you see the government taking the decision that because projects like that are so good at a macro level for driving the economy, that they then understand that from tax dollars, or shillings as the case may be, they would have to support, they'd have to subsidize those projects heavily. So we'll see. I mean, Nairobi has those plans. They're on paper. The question will be if and when we actually see them executed.